Hi there everyone and welcome into this week's market update. Don't forget that any advice contained within this presentation is general only, so it isn't tailored to your particular circumstances and you need to decide for yourself whether it's appropriate to you. Okay, so not much has really changed in the last 7 days since we did our last update. So really we're just stuck sideways. Okay, so last week we did hear from the Fed, or that might have been the week before, but since we've heard from the Fed, really our market struggled to really get back above that 73 in any meaningful way. So we're waiting, right? We're just getting closer and closer and closer to the edge of a triangle pattern there. Okay, so whether you want to call it a pennant, a descending triangle, it all works, right? Just waiting for a breakout, really, guys. There's not much else to say there about the Aussie market right this moment from a technical standpoint. Okay, other than we know it's up in an uptrend. We're reasonably confident that the uptrend is going to continue. Typically, we do see a bit of crazy movement at the end of the financial year, which we're a couple of days away from at this point of time. So, look, cyclically, last week of June is usually very weak. Then we start running July into that August reporting season. So, look, could be a few more days left in this whippy sideways bearish type of momentum that we've been seeing, but doesn't seem like it's going to really last to the medium or long term. Now, S&P 500's managed to continue to edge into all-time highs all throughout the last week. So with that being in blue skies, all our short-term indicators are looking a little bit overdone. But in saying that, we are heading into the next reporting season. So unless they have bad reporting season, guys, chances are it'll either go sideways or higher, right? We're still pretty bullish from here. There's still a lot to be bullish about for the stock market. Obviously, there's a lot of complex issues around the economies of the world, but really at this point of time, from a stock market perspective, this bubble's going to get much bigger before it explodes, guys. Okay, so we're still very bullish, right? Overall, medium to long term. Short term for the US markets also agree with that. So at this point in time, we're expecting it to keep going up to sideways. It will always be another small pullback on the table somewhere. Don't know where that is at this point in time, but one way or the other, that trend is up. We've got a breakout happening, and we're coming into a reporting season for the US in a couple of weeks' time. So I suspect we are going to continue on that upward trajectory for a while now. Okay, so the main things driving markets at the moment, one is end of financial year. That's going to play out for only a few more days here. Usually get a little bit of window dressing, so some people might want to take some tax losses. Sometimes move things around a little bit just to make the tax time a better result for them. So often you can get some weird movements in the market, and we have seen some weird whippy movements this week. So no surprise there really. COVID numbers are probably the big thing for us right now. So really at this stage, I'm not expecting a big pullback or anything like that. Not unless things get out of control. We know lockdowns work, guys, okay, in keeping COVID under control. So yes, it might get a little bit worse before it gets better. But is it going to get much worse with the current lockdowns happening? No, right? It tends to stop COVID in its tracks. In saying that, though, New South Wales was a little bit late to lockdown. Okay, us Victorians, we know lockdown as quick as possible, get it under control, reopen. Okay, New South Wales, they locked down a few suburbs and it didn't quite work for them. Their daily cases are much higher than what ours have been in Victoria for quite some time. So I suspect this won't be just a little 2-week snap lockdown. I suspect this might be a month to 6 weeks, perhaps, is my probably prediction at this point of time. Anything really worse than a month, then yes, you might start seeing the market react a little bit. We already saw some sectors of the market come off quite drastically this week. Travel, for one, has come off quite a bit since mid of last week. Some of the REITs have come off quite a bit as well. So no surprise there. Banks are soft at the moment locally. That could be also to do with the flattening of the yield curve. So there's been a few things that have been really, that's pulled the wind out of the sails of the upward move, right? And some of it's COVID, some of it's bond related. But yes, I'm not surprised really at what we're seeing on the market right now. We need a little bit more certainty to come in, and that really could come in the form of reporting. Reporting is really going to show us where we're at, how companies are rebounding, which companies are doing well, which aren't, and then we might see quite a bit of rotating coming into the market over the next few months on the back of reporting as well. When I say rotating, I mean rotating out of one sector into another on the back of mispricing, things like that. Okay. All right, so COVID numbers, look, we're really going to have to watch how this plays out. Most states are now locked down to each other. So, yeah, look, the likelihood of this getting under control is very, very high. The other snippet of news we saw today was the vaccine rollout has now included for people under 40s. So, yeah, look, I think that's all fairly positive for the market. The take-up's going to be really the interesting part. We'll see how that goes in the near future. All right, so US infrastructure spending is the big one for me. Any physical stimulus to hit the market is positive. This time it is all around US infrastructure, which means a high demand for commodities, metals, all that sort of infrastructure commodities, iron ore, iron. That it's all positive for that space, right? So you've got sort of a bit playing out here where US is, and a lot of other countries are amping up, ready to do infrastructure spending. That's causing, a lot of demand in the commodity space. China's trying to hold the prices down a bit as well, right? So there's a bit of whippiness happening in a lot of those base metals. Iron ore's whipping around a bit now as well. But overall, when you have a look at smooth it out over a month, none of them are really moving far, guys, right? We've seen a small pullback in base metals, seen iron ore still hold above 200, but all in all, if you really look closely at the monthly charts, we're way higher than what we were 12 to 2 years ago, 12 months to 2 years ago, and yeah, it's likely to hold here for a while. I can't see that market crashing just yet, right? I think we're a while off that. All right, so infrastructure spending, it's a big deal, guys. I believe that's why you're starting to see some strength come back into the market. Although last night it really wasn't the recovery stocks that led higher. Oil was probably the main reason why we saw banks and infrastructure stocks off a touch. But they did have a good run into it this week, so yeah, a pullback was on the table anyway, right? I do believe those value type infrastructure stocks are going to outperform still for the rest of the year. Okay, that's my view at this point of time. Look, really, there's not much else to say. This is probably the quiet, a little bit of quiet before the next move. US is edging higher now. Every time they move higher, the momentum's a little bit lower. Okay, so as things are moving higher now, you'll be more and more patient, and that is just the maturing trend, right? As the trend continues on, every move up, it tends to get smaller and smaller unless there's a massive catalyst behind it. And that's what we're waiting for. So, a combination of a lot of Fed comments the other week has taken some of the wind out of the sails. People are worried about increasing interest rates. They are worried about the central banks of the world reversing this extremely accommodative stance. They're worried about inflation. But at the end of the day, there's nothing in stone saying that they're going to increase rates anytime soon, guys. Right? The Fed could easily change their tune next year. A lot of these supply chain issues could sort themselves out in the next 6 months, and inflation could just normalise back to 2%. And if that happens, guys, if inflation's at 2% and the economy is just ticking along, they may not touch interest rates, right? Not for a while yet. Okay, so look, I'm happy to see both sides of the coin right now. All I'll say is in the next 6 to 12 months, we don't need to worry about interest rates. Okay, let's worry about it when they actually start seriously talking about it. At the moment, they're talking about it still. It's a way off, guys. Okay, so yeah, look, I'm still very bullish. That hasn't changed. Let's see what the next lot of reporting shows us. Okay, we're always welcome to change our view after a reporting season. That's what many of us do. So reporting's key. we'll be sitting down analysing, where we want to be, what's outperforming, and what's likely to continue to outperform in the next 6 to 12 months. Okay. For me right now, I'm very interested in the miners. I still think that a lot of analysts aren't pricing in iron ore at $200. Okay, Fortescue's sitting at a forward PE of like 5 or 6, and that's with iron ore maybe at 160 or 170, right? So yeah, look, keep an eye on that space, guys. It is a space that could really rocket around reporting. You have Rio that kicks that reporting off late in July. Okay, so keep an eye on BHP, Rio, Fortescue for a reporting trade. Okay, all right, so I'll leave you at that. Yeah, happy trading. Thanks, and bye for now.